Hey everybody, hey traders, Chris Paul over here. Welcome back to another installment for the video series, Trader's Path to 100%. This is going to be episode 2. I was traveling a lot the last couple of weeks, so I didn't get a chance to do the weekly update, but it's been about a week and a half since episode 1. So this time I'm going to dive in a little bit deeper and just show you some of the positions I'm in, the assets I'm in. Had a great discussion this week in my Equities on Demand trading room and just kind of assessing the overall market. So let's dive in. I'll get rid of this. This is one of my accounts here, sitting around $40,000. Just going to show you that I've got a combination of equities and options. I'm going to log into my Forex account as well. So we'll just spot check a little bit of everything. This is A to Z. You can see some of the symbols I'm in. I don't love all of them, okay? If you're going A to Z, here's my recommendation right now for anybody out there that's trading a stock portfolio with options exposure. I think right now we're in this big period of uncertainty. I'll go to the technicals really quickly. I was just talking about this in my trading room today. So this is the equal weighted S&P 500. It is actually down 2% for the year versus the S&P 500, which is still clinging on to like 9 or 10% up on the year. All I am saying on the equal weighted versus the S&P is we're not really sure if the market is going to have what it takes to go up. All right. Some analysis I did this morning. This is big picture stuff. Okay. This is the SPX on the weekly time frame. The broadening pattern seems to make sense. It's a difficult one to trade for a lot of traders because, the lows break and then you want to get short, and then the highs break, you want to get long. Well, you can see that that's essentially a trap on either side. So what I'm talking about now is perhaps we are in an environment where this, the Fed stepped in, the Fed stepped in, the Fed stepped in. Right now we're in an environment where the Fed was tightening. The market is basically facing the reality of higher for longer. So is this a correction coming to the downside, right? If this is the case, then I would look for the SPX to close below 4,200, and this brings in, a whole new conversation of making fresh lows, revisiting the lows from 2022. I'm not saying this is going to happen, but I'm saying I don't want to be surprised if we are, looking at stocks and the overall markets heading lower, okay? So what I'm doing in my own portfolios right now, I'll just type this out. What I'm doing in my own portfolios is if I own stocks, so 100, well, I can put fractional shares. I mean, some traders with smaller accounts, you can't afford to have 100 shares, right? If you want to buy the SPY at $420, do you have 40 grand to just allocate to the SPY? Maybe you don't. So fractional shares, you can buy fractional ETF shares. You can buy, fractional shares with a lot of brokers now on Amazon and Google and some of your big market cap stocks. But if you have fractional shares, continue to look for DCA levels. And DCA just means dollar cost averaging. So I like, 10%, 20%. And if you want to space it out a little bit more, let's go like 10% and then maybe a 25% and then maybe a, 50%. Anything that's just, anything that's down, 80, 90%, you're basically guessing that it's a value stock at that point, but that's an incredible amount of value that just deteriorates. So, I'm not looking for stocks to drop 50%. That's not what I'm saying. But I'm saying if there's stocks that I want to own longer term and I don't have enough money to have 100 plus shares and control options and lower my cost base and be a little bit more agile, fractional shares are a great way to dollar cost average, and these are some pretty nice increments to pay attention to. So wherever you buy it, if I bought the S&P 500 or the SPY at $450, well, I would just measure 10% lower, 25% lower, 50% lower, set some chart alarms, and then be prepared to add the same dollar amount. So if I bought $1,000 worth of SPY, 25% lower, I buy another $1,000. 25% or 50% lower from my initial spot, I buy another, $1,000. So, you'd have to keep track of your pie and how this all shapes out. But long story short is if I own stocks in the fractional shares, I'm looking for dollar cost averaging levels. If I have 100 plus shares to trade options, what I'm looking for are opportunities to play defense, right? So a long put against my own shares. That means that if I own, and I'll just use an example here, I had a $40 assignment on Alcoa, which is the ticker AA. and I had a $40 assignment with a $35 put. The price on Alcoa right now is $27. Okay, so 35 to 27 is $8. So I get a credit spread credit, and that was around $2.50. And then I also have an $8 put, and that's if I take profit on it right now. So I will show you how I can calculate my break even. If I look at Alcoa and I collected 250, which I know we collected a little bit more of that in the trading room. So I get assigned at $40. I take 250 on the initial bull put spread or the credit spread, and then I close out a long put for $8. My break even on Alcoa is $29.50, and the stock is trading around $28. So rather than owning the shares at 40, I actually own with options, I own the stock with a break even at $29.50. So if the price returns to $30 or $32 or $35, I actually have profit on Alcoa. And I don't need to have price go all the way back to $40, right? So this is the beautiful thing about having enough buying power to trade 100 plus shares and then trade options around it. So I'm playing defense. And what I mean by that is if I own 100 plus shares, for every 100 shares, I'm at least adding one contract and a put. And so I talked about this in my Equities on my trading room. I'm looking at like a 25 and 30 delta long put. And if some of this terminology doesn't make sense, just leave me a comment, ask me to clarify, join me for one of my live sessions, ask me the question on the spot, and I can explain. But these are ways that I look at, I don't want to pay a ton of money to trade a long option, right? So for me, if I own the shares at 40 and I have a put at 35, the put is in value right now. But if I did a fresh trade, I would look out, at probably a strike that's considered out of the money. So I'll just use another example. Let's say it is, I'll use a stock. I'm trying to think here, CCL. Okay, CCL. So I have, I had 300 shares of CCL, and my break even is around, let's just say that I own it at $15. Okay, and this is my break even ownership price. Now, in order to have protection, if I thought, there's a chance that CCL might drop to $10, it might drop to $8 or $7, then it might be in my best interest to look at a, $14 or a $13 or a $12 long put. And I would look at what that delta is on that put. All that means is I'm not going at the money. I'm not going to buy a $15 put because it's going to be the most expensive. So I go out a couple of dollars and I kind of put a line in the sand. And I say, look, if CCL drops lower, let's say it drops to $10. Well, if it drops to $10, my $14 put, that's my strike price. It should be worth at least $4. The $13 should be worth at least $3. The $12 worth at least $2, right? So I can lower my cost basis, right? So when I do this, it's like in the event that price falls, the long put gains in value, okay? And if there's enough time in our option trade, we can ride the move lower and lower our cost basis the entire way. Okay. Now it may not be dollar for dollar, right? If I did a $14 put and I get $4 of value out of that, I might have to pay $1 for it, right? I pay $1, I see the credit trading at $4, so I make a net $3. Well, that allows me to at least lower my cost basis from $15 down to $12, which is better than nothing, right? So I don't have to just go in and, buy more shares of CCL and then buy more shares of CCL. I don't want to have to allocate more if I don't have to. I'm trying to keep it, I'm trying to keep the risk pretty tight. But using protection, using puts is a good thing. So this is what I'm doing on all of my own shares. I'm looking to protect my position with a 25 to 30 delta long put. It's somewhat out of the money. I'm not trying to pay a ton for it. And I'm also doing a couple things. I'm doing 30-day expirations or up to like 45-day expirations to cover this uncertainty, okay? Putting on protection all the time, it's nice to know you have the insurance, but doing it all the time is just going to cost more money, and it's going to be, increasing your cost basis. But if we enter these periods where, man, the market is down, the market is falling, sentiment is bad, things are looking ugly, I mean, going out 30 to 45 days, sometimes the market just gets these nasty spells over with and cleanses itself, and then we start to see the market's ready to go up again. So we don't have to go out, 6 months or 12 months to go these long dated puts because they're very expensive to do that. So I typically like those chunks of 30 to 45 days for protection. That way it doesn't cost me a ton of money. If I'm right and I can protect some put profit, great. It lowers my cost basis. If I'm wrong, well, I just pony back up and do another 30 to 45 days and buy some more protection if I'm still uncertain of the current environment. Okay. If it's cheap for protection, which would be a long put, then look, 6 months to 12 months. It might cost a little bit more for that option, but if it's not super expensive, just compare it. I mean, look at a 45-day option and then look at a 6-month option. If I pay like $1 more, that gives me a lot more time in the trade where it's like I don't have to reset the trade every 30 to 45 days. So, if it's not expensive, I might go further out in time. But point is, I'm playing defense. Okay, so this is kind of step one with if I own stocks, if I have fractional shares, it's just dollar cost averaging levels and keep the dollar amount under control. Be pretty diversified. I have exposure. I talked about this in episode 1. I have exposure in materials. I have exposure in U.S. stocks, non-U.S. stocks, some tech. I'm getting into more healthcare stocks. I'm getting into utility stocks. I mean, I'm trying to be pretty diversified sector-wise because I'm not really sure where the next big move is going to be. This year's all been about AI and technology, and the market's made this big recovery, but it has clearly given some of it back over the last couple of months. Okay, so I'm playing defense right now, and I'm playing for protection. Furthermore, okay, as far as additional shares, at this point in time, if the market is showing uncertainty, when we see bearish sentiment and fear and uncertainty, Warren Buffett's saying is be greedy when others are fearful and be fearful when others are greedy, right? You know that. There's a time and a place to do that. If the market is just kind of slowly falling, look for the big percentage levels to consider having the courage to buy stuff, right? I mean, 2020 is a good example. Everything was crazy bad. But why did I start buying stuff in 2020? Because we came back within a month or two with that crazy sell-off we had in February and March in 2020. A lot of stocks came back to levels that we haven't seen since 2008. So to me, that was a technical bargain to just have the courage to buy some stuff. And it obviously worked out pretty well for a couple of years. But in a environment where kind of everything is selling off, the broad market is selling off, I don't want to own more right now. Okay? Look at major support, 10 to 20 to 30-year lows, and then I'm willing to buy more. Okay, stock right now that I'm in, AT&T, the ticker is T. AT&T is trading around $14 and change. It's at 30-year lows. There's no guarantee that it can't go lower, but as I'm owning shares of AT&T with a break even around $16 or $17, to me, I think the downside is pretty limited for the upside potential. And so if I'm willing to own more shares, it's because we're sitting at, 2020 lows. We're sitting at 2008, 2009 lows. We're sitting at all-time lows, whatever it is. If I still like the stock and it checks out fundamentally, I want stocks that still have cash flow, still have limited debt. They're not burdened by higher interest rates, right? These are all important things when it comes to checking out your fundamentals. If you have software, you can look at FinViz free website. I have a platform called Simply Wall Street where I look at the snowflake analysis and kind of gives me an at a glance thing for a lot of stocks I trade. So all this stuff on stocks, fractional shares if you don't have a big account, using options and playing defense and being protective right now as things fall. Because right now the market is, we're seeing that there's nowhere to hide in stocks and bonds. That's my concern right now. We felt a lot of this last year. We had a great kind of inflation trade going into the first half of 2022. We had a great technology trade going into the first half of 2023. But there's a difference between like market cap weighted, where it's like this thin move by very few stocks, and then the broader market is kind of weighing it down. So this year was interesting because the broader market, we had the broad market flat and the large mega cap value tech was super, super bullish. And so this carried the broader market with it. Okay. Now we're to the point where the broader market is ripping back lower and value tech is stalling, and the broader market has enough to finally pull the bigger tech down with it. So the broader market now is being a little more dominant, where it's basically holding the gains. It's holding back on the gains from these, larger cap mega value stocks. So your Apples, your Teslas, your Nvidias, your Googles, your Microsofts, all those stocks are getting, dragged lower now because of the broader market struggling. If you look at the broader market right now, and I've talked about this in my trading rooms, something like FinViz, this will give you the market breadth. Right now we have almost 85% of stocks, publicly traded stocks, almost 85% are down below the 50 period moving average. That's crazy, right? And then almost 72% are below the 200 moving average. This is on a daily time frame. That is a broader seller's market for sure. Okay? So the market breadth is bearish and it is weighing in on everything else. Now, what's interesting, I'm taking a look at this as I'm doing the video. Everything seems to be in green, like Tesla's up and Google's up and Amazon's up and Microsoft up. That's interesting that happens to be the enormous 8 or the Mag 7. So they've become like this risk-off trade where it's like, if anybody's putting money in the market, put it in these value tech stocks. And all it's doing is making concentration higher and making market cap greater and greater. So I'm not saying this is foolproof, but I don't love it. I mean, look at the difference between like tech is getting a rally today, the Mag 7 enormous 8 are doing well today, and energy is down by a lot. Like that's your most obvious red sector. So we have some interesting kind of risk on, risk off flows and how the market's moving with sectors and whatnot. But like I said, broader market, I mean, here's what I'm looking at right now, and I'll get into my stock portfolio in just a second. Let me go to the daily time frame. Okay. This is what I'm looking at right now. If I see kind of a uniform correction like this, then 420, if you want to write this down, like 4,200 on the SPX or 420 on the SPY, 420 on the SPY has the potential to hold and go back up to channel highs. And we could go from low 420s back up to like 438 to 440. I could see that happening in the short term, and then that move gets faded. And then we go back up and this move gets faded. And the bulls, to really be in control, are going to have to break this structure. The bears, if they want to get really ugly and nasty, can break this structure. But just like we had in 2022, the market actually had some pretty obedient corrections. And in 2023, we had a nice little rally, and the market could have some obedient corrections. So maybe it's not, it's super bearish or it's super bullish. Maybe it's not that easy. Maybe we have to trade structure. Okay. So this week and next week, 420 is a big level, because if we hold 420, I think the market has room to go up another $15, $20. And again, percentage-wise, that might be a few percent, but it's at least something I can trade in the short term, okay? But what I'm getting at here with this, just kind of overview for episode 2 is I'm playing defense in my stock and options portfolio. That's the most important thing to take away from this. I'm not looking to own new stocks. I'm not looking to get assigned new stocks. If I get assigned from my broker on credit spreads and options, I am closing out the long put, closing out the shares, and I'm taking a small loss. If I get into an option trade for 50 cents credit, I'll take the 50-cent loss. I don't want to take on new shares, and I don't want to deplete my buying power, okay? So having said that as today's preface, I'll try to keep the video another, couple of minutes here, but basically, what stocks am I in? If you want to take a screenshot of this or copy what I'm doing, I don't care. These aren't perfect. This isn't foolproof, but these are some of the asymmetry symbols I'm looking for. Alcoa, I'm looking for options. I'm looking for stock ownership. I think Alcoa has the ability to get back up to $50, $60, is trading at, mid-20s. Amazon's trading at 130 to, it's 126 right now. I think Amazon, give it 3-5 years. I think Amazon, we're talking about this stock at, $250, $300. Longer term, I wouldn't be surprised before another split happens, Amazon's going to be a $1,000 stock again. Same thing with Apple, same thing with Meta, same thing with Google. A 10-to-1 split is not uncommon, but that gives them room for these crazy tech stocks to run and have this, Amazon's a behemoth, right? I have some non-US exposure. Some of the big ones I'm trading right here, Alibaba and Baidu. I have some shares. I have a lot of options in my other accounts. BITO is a Bitcoin-based ETF. I have some options around that as well. CLF is a steel play. FXI is a copper play. Okay, this is that FXI? Large cap ETF? No, I'm thinking of FCX, sorry. FXI is a large cap ETF for China. So I'm looking for BABA, Baidu, FXI. This is China exposure. Again, through a little bit of share ownership and a lot of options. AT&T, this is a value play for me. We're trading at $14.56. I think upwards of $25 to $30. It also has a 7.5% to 8% dividend. So even owning shares of AT&T right now and having it go nowhere, I still make a nice little return on just dividends and reinvestments. And then uranium play. This has made some more headlines the last couple of months. URA, URNM. I'm looking for, URA to head up towards $40 to $50. URNM heading up to like $70 to $80. It's going to take some time. We've had a violent pullback the last couple of days. That's fine. I have some puts, not on these stocks, but on my other accounts, I have some puts on URA, URNM to protect the downside. This one, I'm just going to dollar cost average in and kind of double my position if we pull back a little bit deeper. Okay, check on this account here. Alcoa, Affirm, that's a little buy now, pay later. CCL is Carnival Cruise Line. CLF is Steel. Comcast, some option trades. Intel, it's tech. It's value. I have a bunch of options here. I'm still up, $650, and it's just an option trade. We've collected a lot of income this year on staggered credit spreads. Some defensive plays: KDP, KHC. This is Keurig Dr. Pepper. KHC, I own some shares here. I'm playing defense on this. I can start getting some puts in as well. LTHM is, I believe it's an energy play with some batteries. Pfizer, big pharma. There's COVID stuff. There's weight loss stuff. There's everything that Pfizer does. It's major pharma. It's to me, it's it's a 4 to 5% dividend. It's low volatility. I'm using options to lower my cost basis. If we get back up to like $40 or better, I'll start taking profit on maybe a $3 to $4 share move. Rig is a little energy play. The rest I'm just kind of mulling over here. But Rig I like as far as share ownership. There's upwards of like $14 a share, $20 a share. We're trading at $7.38 right now. Under Armour is retail. I like Under Armour going back to like $15 to $20. It's going to take some time. The consumer needs to show a lot more strength. There's my URA, URNM as well. That's a little bit of splits in the portfolio. This account, like I said, I'm sitting around 40K, trying to get this one back up to 80 to 100. That's my trader's path to 100%. This one I just talked about here, that's a small account that I just started around. This was around $30,000. I'm in a drawdown right now. A lot of the drawdown is Amazon and Alcoa, and that's fine because the drawdown is sitting with put protection. So I have put protection on Alcoa. I have put protection on Amazon just in case. I obviously might lose. I might make some money. I might lower my cost basis. I might not. But longer term, I'm bullish on both of those. I come over to this other account here. This is a small account. This is a Roth IRA. I'm doing a lot of money market instruments. I'm doing some safe plays with treasuries. I have a couple of ownership stocks. There's Alcoa, there's Amazon, there's some Baidu exposure. HNDL and MYD, those are basically like high yield growth things. I get like 5 to 6% yield a year. They're monthly dividends. It goes back in. I dollar cost average into them. JetBlue is airlines. Delta's airlines. I'm just playing JetBlue because it's dirt cheap right now. I don't have any shares on it. I have it in my other account, but I think JetBlue has, it's either a buyout target like Delta buys JetBlue, or there's the JetBlue and Spirit merger that might come back and make some headlines, or I just lose on an option trade, which isn't a big deal. But then I go into my other account here, and this one's a lot busier. I've been trading this one for the last couple of years actively with my Equities on Demand trading room, and we have a lot of trades here. So I have some stocks that I own. I have some Alcoa, some Apple, some Amazon, some Affirm. I have a ton of options here. This shows a lot of positions. If you want to slow this down and look at some of the symbols here, I owned some Chewy recently. That is retail on pet supplies and pet food. I use Chewy all the time. My dog is a very he's not special needs, but I treat him like he is just because he has a sensitive diet and he's, super needy. But anyway, people do a lot of stuff for their dogs, right? Chewy's great. It's like Amazon for pets. And honestly, Chewy might be on its own for a while, but it might be a buyout target from a company like Amazon because logistically it's almost the exact same thing. So, could Chewy from $18 a share all of a sudden be bought by Amazon at 25 to $30 a share? It's very possible. So I have some ownership. I'm going to stick with it. Got a bunch of credit spreads around it. There's my steel play. There's some communications with, telecommunications with the Comcast. Costco, dollar cost averaging, some defensives. I said KDP and KHC. This is Campbell Soup. There's some energy right there. Disney's dollar cost averaging. Ford and GM started to get into some of those after the UAW strike. GoodRx. If anybody's used like telehealth things or Teladoc, GoodRx is dirt cheap. It's $5. I'm upside down with a break even around $9 or $10, but I'm going to give it a chance. Just sitting on it doesn't cost me a lot of money to allocate like $500 to it. GM, a bunch of options and credit spreads. There's my Intel. International Paper, that's material plays. There's my JetBlue. KDP defensive. KWeb is another thing with China Tech. LUV is airline exposure. MRO is an energy play. NCLH is airlines. There's another energy play. Pfizer for big pharma. PayPal for some tech. Roblox for some tech and user base. Rig owns some shares plus some credit spreads. Rivian, that's all in profit. I could probably, well, let it decay a little bit further for July. SHY, little bond exposure, nothing crazy. I might end up losing on bonds. It's fine. I'm not trying to call the bottoms here. SLV, I do like silver a lot. My break even on silver and SLV is around $17. Stock's still sitting at 1924. It shows that I'm upside down because this broker platform doesn't show what I've taken in for options. So I've made a lot of money on credit spreads. My SLV ownership price is down to like $17.50. So I'm still sitting in profit. I'm not going to close it yet. I don't want to touch silver or SLV until we're back up to like $27 or $28. SoFi, couple things: business loans, consumer credit, student loans, servicing. I own the shares. I've dumped up half of my position. I had 600 shares earlier. I wanted some buying power back. I didn't want to have all this exposure and margin tied up in SoFi, so I dumped half the shares. But upside wise, I mean, have a bunch of credit spreads and profit. I have some shares. I'm looking for this to go back to like $15 or $20. I'll turn it into a nice win. Rocket, same thing. I have some shares here with Rocket. I have 400 shares. I'm upside down about 50% of my position, but I think this one also has good upside potential for like a 1 to 2x gain. And then let's see, options on the SPY, AT&T, my value play with some dividends, Under Armour for retail. I know that I'm talking super fast. If you need to play this video slower so I can slow my voice down, go ahead. But I just want to get through these portfolios for you. And one more at a glance is my Forex account. And this was an account that I intended to double. I was up about $370. We're having some pullbacks here. It's okay. I want to get filled on some pullbacks. I'm looking to see if my trade sizes increase. We talked about it this week in class for my portfolio builder class. I want pullbacks, okay? So if this is a low to high swing pullback here, and then we have another wave coming, I'm hoping I get filled, and all of a sudden we're talking about positive growth. So, I have a $10,000 account. I'm up $162. I've only used about $876 in margin. Plenty of firepower left to add positions. So this is my unit size. This is my total margin. Pip-wise, you can see that of the positions, I'm only upside down on one of them. I've just given back some fluctuated positions with some of these pullbacks, right? When we were up here, I was up about 600 pips total in my portfolio. I'm not taking profit yet. I've talked about this in class. Like, I am building positions to make these bigger. I'm watching wave structures to then start adding to my winners. I'm just being patient. I'm essentially using this right now as I'm testing. I want to test the validity of some of these patterns, right? If I'm right and this is going to be a wave 3, guess what? I'm going to add, and get some profit. And we can build this up a little bit bigger. We can see our profits and P&L increase, and then we can start talking about profit protection on a 3 or 5 wave move. Okay, so it's still profit. I'm still playing with house money. I've had a little bit of a draw back, but I'm still up in the overall account, and I'll just keep monitoring my positions, see if I get filled on some pullbacks. So account, couple accounts here, and my Forex account as well. Just kind of give you another overview for episode 2 of Trader's Path to 100%. I hope this helps. I know it's a lot of information to kind of throw out there. I've had some traders asking me, like, I want to follow. Where do I sign up? This isn't anything you have to sign up for. I'm just going to show you what I'm doing, right? The most important thing for the first 5 or 10 minutes of this video was I am playing defense right now, right? My stocks, my options, I'm playing defense. I want to make sure that if anything happens to the downside, I want to be riding those downsides to protect my positions, right? I might not make profit necessarily, but I can protect my positions. So if I own something at $40, but I can ride it down to 30, great. I'd rather do that and have my break even be much closer to actual price, right? As opposed to I own it at 40, it drops to 20, now I still own it at 40, and I'm just sitting in a 50% drawdown. No bueno. Okay, so protection is important. If you don't have the type of buying power to buy puts and control the ownership of those shares with 100 plus shares, then it's going to be a pie allocation of dollar cost averaging. And, whatever your account is, if you have $5,000 to $10,000, maybe you're looking at, I'll allocate $2,500 towards fractional shares and get, a diversified account of, have some tech, have some materials, have some, defensive plays and maybe some financial, some healthcare. I mean, think about sector diversification. There's a lot of ways to do it, right? Diversification is good, okay? The problem right now in the overall market, and this happened in 2022, is sometimes the stock market makes you feel like there's nowhere to hide. And so that is also why I trade Forex. If there's an opportunity in Forex, we had some positions get filled last night on some of these yen crosses where this big spike to the downside tapped me in on a couple of sell stop levels. So I'm actively short on the euro yen, pound yen, Swiss yen. And because it's a JPY cross, this may be putting in some type of head and shoulders trade, maybe, okay? So what I'm hoping for is that this high does not get invalidated, and this is a entry. We come back and find some efficiency, and then this market starts to sell back off. If we get back down to this low or challenge this low, I might take some profit and then look for a bigger pattern to trade. So if you're like, I need a market I can trade in bull and bear markets, learn how to be a currency trader. I've done it for 15 years, and anytime we have a bull market or we have a bear market, currencies allow you to trade risk on, risk off very, very well. Okay. Stock market, sometimes there are sectors that do well, other times literally everything is in red. And what I've seen the last 3-4 years is that the 60-40 split between equities and bonds is not the same way it used to be. Bonds are not offering the same type of protection. Bonds have been in a 3-year drawdown. They're awful. They're breaking fresh lows. Something might be brewing where we might have a big old crash in bonds. And then we have an intervention, then we have a reactive Fed, and then we have something for better price stability. And there could be great opportunity ahead. But I certainly don't want to be caught holding the bag on some type of open position where a crash is going to crush my portfolio and I don't have the money to build myself back out of it. Okay, so play defense, be protective, be careful out there. And this is how I'm positioning. And when there's a time and a place for sentiment to shift, like right now, we're seeing that sentiment is pretty ugly. In fact, we're seeing some of the most bearish sentiment that we've seen since May of this year. And, historical averages are important. And remember that just because it shows bearish sentiment doesn't mean it has to go lower. It just means that there's a lot of fear building in the markets right now, right? Early September, it was mostly bullish. Mid-September, starting to neutralize. Now we're in October and the market is actually overly bearish. So the averages, right? The average is 31%. So we're well above that. So what am I watching for? Well, if it gets too extreme to the bearish side and sentiment-wise, I'm going to start looking for some buying opportunities because this is kind of a contrarian play. So anyway, we can talk about that another time. Right? If you have any questions, let me know. I'm sorry the video is so long, but it's a good 30 minutes, and I pretty much didn't stop talking the entire time. So let me know. Leave me some comments. Let me know how I can help. I hope this episode 2 is helpful to see what I'm trading. I don't have a ton of positions from A to Z. I'm essentially working with a portfolio of maybe having like 5 positions in ownership, maybe 5 to 10. And the rest, I trade a lot of options, and I do that because it's not really capital intensive. I can essentially use leverage in the stock market by trading options. But any ownership that I do have, I'm using options to protect myself, lower my cost basis. Everything else, if it's dollar cost averaging, great. If you want to trade bull and bear markets, trade currencies. Okay, so it's a nice way to be diversified and kind of a well-rounded trader. And I'm looking forward to trading, with all of you in the trading rooms and doing my thing and having our live sessions. But also this video series here, I'm looking forward to just seeing our progress. It's not going to be easy, right? If it was easy, everybody would be a trader and everyone would be retiring on their accounts. It's going to be a grind, okay? But there will be a time and a place where, I would love to have a video out there where I can say, I am buying everything I can get my hands on. I am, over leveraging myself essentially because we've got really solid direction and sentiment and momentum. That's a lot easier environment to be in. But if we're not in that environment, we play defense, we protect our butts, and lower our cost basis, right? And then when the coast is clear and things look better, we trade short term, and that turns into medium term, long term, and we make a ton of money. So all good. So I want to let you know. All right, happy to help. Let me know. Subscribe to the channel, all that good stuff. Like the video, and I appreciate you being here. Thanks everybody. Take care. Bye.